Hello, good evening. How are you? How's everybody? We're going to do another recap or really more of a discussion about what's going on. I thought about it. I put up a video Friday. I didn't really like it. I took it down. The primary reason for it is very simple. Everybody is going to be putting out market recaps. Everybody's going to be showing you that the market went down. Everybody's going to be showing you where it's going to go. Everybody's going to be showing you it could go up, it could bottom out, it could go back down. Everybody's going to be giving you all kinds of prices. To me, that's kind of meaningless, and really, it's not very helpful because at this point in time, everybody's just guessing, and they're going to have their technical levels, and they're going to try this, and going to try that, and to a certain extent, it's going to be just a big giant waste of time. And if you want that type of thing, I'm sure you could find a million of these videos because everybody's going to all of a sudden become a master in technical analysis and all of these wonderful things. So I'm going to go with a different approach. Um, I'm going to call this the US's Brexit moment. I think that's an apropos title. I'm going to go through a few points that I jotted down that I was thinking about and kind of put some pieces together as to what's going on, why we're doing what we're doing, where things could end up, why are we having this temper tantrum? What's the reality? What's really happening over here? Okay, so I think that might be more beneficial and it'll be a lot easier to digest as opposed to just looking at a chart. And I have the chart up of the S&P, but just looking at a chart and just trying to sit here trying to, you know, write out levels and think that everything's going to go there because it kind of just doesn't make sense. Okay, so we're going to go a little bit more macro today. Okay, with that being said, so here we go. Wait a second. Okay, number one, the environment, not the trading, but the actual environment feels very, very similar to '08, where nobody really knew what was going on or what was going to happen. And there's so much uncertainty out come in the marketplace right now, just on a global scale, and that's really how big of an event this has been because it's really the uncertainty that nobody really understands what's really going on. So it's very similar to '08 in that situation. There were a lot of long only funds that were to a certain extent caught off guard by this, and they didn't think that the announcement was going to be as massive as it was. Because if you remember going into this Monday, Tuesday, Wednesday, listen, we've all know this was coming. Okay, we all knew this was coming. Yet all of a sudden Thursday, Friday, we just imploded. Why? Because the approach was that maybe the administration is not going to go through with it. The administration likes to talk a lot. The bark is bigger than the bite. And a lot of long only funds were completely caught off guard by this, completely. So, knowing that the markets hate uncertainty, and now we have this massive amount of uncertainty, the market is trying to figure out what to do. The other issue was that we took the worst possible path possible. And that we're on the worst path possible. That's what we took, the direction we took. So that's also what kind of caught everybody off guard. The end game to a large extent does make sense. We want to bring back jobs to the US. We want to incentivize companies to bring manufacturing back to the US. These are all good things. However, the path forward is to a large extent utter chaos, which is really the issue. Um, you can't undo multi-generational capital plans in a day. You just can't do that. And that's really what that poster board was. We're basically undoing all of these multi-generational capital plans that companies have in place in a day. And the other part is that the math behind this really also doesn't make much sense. The math doesn't work. From my research and from what I'm hearing and from what I've seen and from just kind of putting it together, it seems as though they took the trade deficit with a particular partner or a country and used the amount that they buy from us and then did a percentage, and that's what they based the tariffs on. So it really appears like nothing really went into this to kind of get this correct. And on top of that, more importantly, it also doesn't help that the Treasury Secretary is out there saying that he wasn't involved in this or that he wasn't really involved. So the people that have to be in the know were not really involved here. And again, the math just doesn't make sense. I'm not going to go into the ins and outs. I could just give you one example. Madagascar is one. Look at that. The math just doesn't make sense what was happening over here. Um, you can make the argument that some people are going to be making the argument that yields are back below 4% as of Friday's close, and that would appear as a good thing. However, I'm on record saying this a million times. Yields dropping for the wrong reason is the worst kind of drop because what's happening is credit spreads are widening. In essence, credit spreads are blowing out, completely blowing out. And since the US is a financialized economy, and this has really been the case since 2008 when we really went into the QE program, you just can't unwind that in a minute. So that's another issue that we're dealing with. Um, I do think that some of these things are going to be undone. I do eventually think some of these things are going to get undone. However, from a trust perspective, the damage is done and will be long lasting because no one's really going to want to trust, who's going to trust the US here, really as a partner. One of the damages that we could see, just take a drink, sorry. One of the damages that we could see is that there could be a permanent valuation based damage where people are going to be reevaluating how much they're willing to pay for the US stock market because again, it becomes now a matter of trust. So S&P, where are we? Right now, we're about 25 times earnings. We should probably be around 22, maybe a little bit lower. You have to assume that um, kind of the numbers are going to be brought down. So you're going to see that the S&P, S&P forward earnings are going to be brought, if these companies are going to be brought down. So you can buy things, that aren't going to be impacted, that aren't going to be so much impacted by this. But I would be very careful with what you're buying. I definitely would be a little bit careful going all in short because eventually cooler heads are going to prevail. Another thing that could be a positive for traders is that since '08, the place to be has basically been in indexes. You've pretty much been able to really capitalize in the market being a passive investor in indexes. I think that it's very possible that the um, gloves are off and the age of the stock picker may be coming back. And I think it's going to be a very, very, life is going to be exceedingly hard for the average investor who's used to just going passive into indexes. Um, we were headed into a slowdown anyway. I mean, it's been obvious from the data that's been coming out, and basically this announcement to a large extent just accelerated it. And the reality is that if something's cheap and you have a company that's been getting hit and it's cheap, in a recession, nobody cares how cheap something is. They don't care. They won't buy it. So you really just take caution knowing what you own and why. However, however, if none of this gets clawed back, zero, and we just keep going with this hard-headed, steadfast, we're not backing off. I would say S&P probably is getting back to 4850 at a minimum. So 4850 basically puts you back to um, the December, January 21, December 2021, December 22 highs, which is kind of the breakout point but I think we might go even lower than that. 4850 is probably the minimum, and we may even go lower than that. Because you have to think, if you're the CEO of a company, are you going to undo your CapEx plan now, knowing that in 4 years, number one, it could be undone, and you're just not going to do it. So, and policy could be changing, and policy could change on a dime now. So, are you really going to start adjusting? The answer is probably not. So, I don't really see companies really doing much on this. Maybe you'll get a couple of announcements to kind of make things, all nice and try and get exemptions, but I don't really see much movement on this. Um, the other thing that we have, and this is really a huge one, is that U.S. debt to GDP is about, let's just say about 1.25 to 100 to 130%. So obviously GDP is gonna take a hit on this. So again, I'm kind of putting out the more bearish case on out there, just to prepare for what's really going on. Um, Bearish doesn't mean the world is coming to an end, all these companies are going to zero. It's just what the bearish case is. We'll get to the bullish case, but that's the where we go with the bearish case. Okay. Um, the truth of the matter is that we finally now just recently started fixing some of the COVID supply chain issues that we were having. We've not fully fixed it. We've adjusted. The global economy has adjusted to it, but now this is going to wreak havoc to it. We basically threw a monkey wrench into it. So, and the other issue is that since '08, we really haven't had like a real cycle, going from into a recession and kind of having like a real economic cycle. We were getting there, and then COVID hit, and then everything obviously got turned upside down. And now, what do we go from here? Because there's no real cycle now. So now we're forcing a recession. So it's everything is being artificial. Um, at the same time, we're trying. Well, prior to this, we were trying to fix the Fed balance sheet. That's why you have the Fed running off, their balance sheet. But now they won't be able to do it, because how do you do that now? You just basically upended global trade. Like what do you do now? So the Fed is not in an envious position. So to a certain extent, it feels a little bit like a U.S. Brexit type of scale, and move, but with no plan. I mean, that's really where we are. I mean, I could foresee bailouts coming, a wave of bailouts for farmers, for the auto industry, for certain chip makers, for I could see it's coming. Potentially, there could be some issues in the banks. Not '08 where they're going to start collapsing, but with credit spreads again blowing out, financing is going to be next to impossible. I mean, good luck trying to finance, a home or an auto or doing any type of securitization. I mean, it's going to be a disaster now with credit spreads blowing out. So yields dropping for the wrong reasons is going to be a nightmare. I will say this, and I've been very, very steadfast in this, and I usually say it a lot. The Fed for years was begging for 2% inflation, thinking that they could control it. They got it, and then obviously we know what happened. It's kind of the same thing over here where, you're begging to listen. Trump has been very, 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 very consistent for over 40 years. He's been talking about how he feels or he's felt that the US was being cheated. I mean, if you look, there's an interview, I think from '88, where he's on Oprah when she had a show and he was talking about this. So he's been very, very consistent with this. But again, you can't you can't upend all of these, 40 years of trade policy and in a day or in a minute and say, okay, fine, now everything's going to be fine. I mean, you're purposely breaking things, hoping to fix it. So again, it's kind of a situation of beware of be careful for what you wish for. And on top of that, the other question you have to ask yourself also is what does this mean for services? Do companies or do countries want to, and other outside partners want to invest in services and service-based companies, whether it be, cruise lines or, airlines, et cetera, things in the service industry. Okay. Again, it comes down to you can't unwind globalization of markets in a night on a poster board. And I know this sounds like it's a political statement, but it's not a political statement because Scott Bessent didn't even know, who's the Treasury Secretary, didn't even know if the additional China tariffs that were slapped on included the 20% that were already in place. So I'm going to regurgitate, but there was no consultation with the people who were supposed to be in the know. So again, no plan. Um, Uncertainty is extremely high, and when things are uncertain, the bias is usually down. One of the issues that we're having, and this is when I say we're wrecking things, is that one of the ways that we've plugged the holes for shipping jobs overseas. And by the way, I'm the first one to tell you, it's a terrible how all these jobs and were shipped overseas, whether it be in these small towns and in Cleveland or in Pennsylvania or whatever. They were all shipped overseas, all these jobs. So how did we plug that hole? We did it with government jobs. Now you have Doge, which is wrecking havoc on government jobs and kind of getting rid of that. So we're having a situation where um, productivity is going to drop and unemployment is going to go up at the same time that we're slapping on all these tariffs, which again are inflationary by nature, which means stagflation, but a monster dose of stagflation. Okay. Um, I would say the reason why this has been going on for so long is, and quite frankly, is the U.S. is not competitive. There's a reason why Steve Jobs chose to build the iPhone in China and other countries and in Taiwan and wherever it's built. Why? Because we're not competitive. from, and also that's how you gain market share. Because if you're a partner and you're saying to yourself, okay, I'm a company, let's say Apple, I want to break into the Chinese market. How can I do it? Well, they're not just going to let me in. So if I say to them, okay, I'll bring jobs to the country and I'll open up manufacturing plants, that's an incentive for the companies, for the countries to let you in. So again, you're talking about multi-generational um, contract. I don't want to say contracts, but multi-generational agreements that are now being upended by all of this. And the bottom line is, it's not political. The US is just not competitive from a manufacturing standpoint. I wish they were, I really do, but we're not. With um, with wages being where they are and taxes and all the political aspects that go into opening up a business here in the US and running it and maintaining it at a profit is very difficult. So that's another issue that companies have to face. So again, asking yourself the same question. Are companies, if you're a CEO of a company, are you going to start upending your CapEx spend to try and figure out where you're going to go in the US? Which state are you going to go to in 4 years from now, policy can be completely different. And more importantly, if this thing goes even more sour, meaning if we drop another 10%, let's just say just because right now the Fed is Powell's hand is being forced. That's number one. But number two, if we drop another 10%, I promise you, Trump is going to find some kind of way to give up and spin it as a win. Somehow it's going to happen because he's not going to allow this market to go another 10%. I could tell you that right now. So are you really going to make this investment? You're not talking about $100. You're talking about billions and billions of dollars. So are they really going to do it? The answer is no, because their boards are not going to let them do it. Okay. So, one of the other things that they're trying to do on the good side is they're trying to push these tax cuts, federal tax cuts. It's a good thing, but the problem is you're trying to push it in a slowing economy. So you're going to lower when you have an economy slowing, you're going to try and reduce tax receipts. I don't think it's going to happen. I don't think it's going to happen. And another thing to consider, and I'm finishing off my points, but another thing to consider is that which no one was really thinking about is that we have a lot of debt, U.S. debt that's rolling over this year. It's about $8 trillion, give or take, and we need lower interest rates in order to service that debt. So you have to ask how are we going to pay for it? And with rates where they are, that's number one. Number two, we also have an issue where we've just alienated all the buyers of our debt because we basically said to everybody, hey, you treat us unfairly. We came up with some kind of cockamamie formula for how we're slapping on tariffs to you, which don't even make sense. And the whole formula is backwards and asinine. So why should I buy your debt now? So that's a big challenge. It's a very, very big challenge. We need lower interest rates in order to service this debt. Okay. On the bright side, on the bright side, we've done something like this historically we've done something like this before. We did it actually twice. We did it once in the early 80s with Volcker Reagan, and we did it once in the early 20s. That's really how we kind of sparked the roaring 20s to a certain extent. We've done this before. When we did it, it usually sunk the economy within 6 months of doing it, but then we were able to stabilize and come roaring back, like really, really, really strong. In the 20s, you had the Roaring 20s. This was the spark plug for the Roaring 20s, and then obviously in the 80s with Volcker and Reagan, we had this amazing, amazing time in the 80s going into the 90s. It really sparked things. The difference between then and now is we're in an age of social media, technology. We're globalized more than we've ever been. Does it work? I don't know. But there is historic precedence for this for us to do this. So it's not like we're just kind of picking numbers out of a hat and just saying, okay, let's see what happens. There is historic precedence. I just don't know if it's going to work this time, just based off of the way the global economy operates, and especially in an age of information. I don't know. I will tell you, QE is I don't want to say probably coming back, is definitely coming back. Powell's hand is going to be forced. The Fed put is there, but it's a lot lower, like a lot lower. I do believe, I do believe that we will at some point. I don't think the bottom is here. I think the bottom is lower. I think we could get 48.50. I think we're going to kiss it. Where we go from there, we may even get down. I know this sounds weird, but we could get down to 4,700 on the S&P, even possibly 46, and maybe even 45. I wouldn't be surprised if we got to 45. I don't want to just pick numbers. I'm just saying is I wouldn't be surprised if we got there. So let's just assume 10% from here. Okay. Let's just assume for the sake of this discussion. So 10% from here. So 5074 times 10%, right? Is 507 points. So 5074 minus 507 puts us at around 4567. Okay. That's where I'm getting my number from. Okay. I'm not looking at a chart. I don't care about the chart. I'm looking at percentages. Okay. Institutions always look at percentages. They're not looking, yeah, they have technical analysts, but they're looking at percentages. It's percent down. So that's how I get that 4,500 target. But again, a lot of things are breaking now. You cannot have an economy that's a financialized economy. The US economy is a financial consumption based economy. You cannot have economy like that, and then in a 1 hour press conference upend the entire globalization and think it's going to work and everything's going to be beautiful. It doesn't work that way. So we're in for a rocky road. Now the only thing, are there going to be bounces? Yes, they're going to be bounces. Is every bounce now going to be buy it, go all in, balls to the wall long? Absolutely, positively, don't freaking do it. Okay? I don't care what anyone tells you. Don't do it. The bounces are going to be in a bear market, which is what we're in tech. In a bear market, every bounce is violent and vicious. Every single one of them. Rips are going to get sold, but every bounce is insanely violent and insanely vicious. And you're going to think it's the all clear because, oh, yeah, yeah, yeah. There are a lot of issues. I laid it out for you. All of the issues that are there right now. None of this is going to be solved in minutes. I don't care how many phone calls you hear in the media about, oh, I had a phone call with this. Unless something changes in the way that we do something on the fiscal policy level, we're going a lot lower, a lot lower. So again, 4850 to 4500 is kind of my area where I think we're going. How we get there, I'm not sure. I think it's going to be a wild ride. I think it's going to be very scary. And to be honest with you, when we get down there, most people are not going to even want to buy anything because they're going to be too scared. Um, because that's usually what happens. However, just from a long-term perspective, historically the S&P goes up. This is 15 years of the S&P. You could see it. You could see the direction. Okay, and you can see the acceleration from the COVID lows. Okay, these are the COVID lows. Okay, up until 22. Then we had a pullback, and then look at this. We've basically gone from, let's see, this is 22, from October of 22. Sorry, yeah, October of 22 till now. It's basically been a straight line. So this retracement, it's scary. I get it. There's a lot of issues. There's a lot of shock into the system, but this storm will pass. It's very frightening. I'm not going to tell you it's not. There are a lot of people out there who are very scared, and and I'm talking about retirees or people who are close to retirement who have seen tens of thousands of their retirement money wiped out in 2 days. Some even in the six figures wiped out. It's very scary for a lot of people out there. So you have to understand that there is a human element to this. You cannot be just, yeah, short everything, everything's going to zero. Yeah, 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 yeah. There are real ramifications to this. Okay. Am I sitting here telling you don't short? I'm not saying that. I'm just saying is tactfully understand that there's a lot going on. It's not just, buy here, sell there. There's so much going on. And to be honest with you, one of the things that's really also kind of making me a little bit nervous, and this is just in Stockland, but one of the things that's making me a little bit nervous, I'm going to go here for a quick second, is oil. Okay. Oil right now is at 62. Oil was down in 2 days, something like 10%. I think it was down 8% for the week, 8.5% for the week. Okay. What's making me nervous about oil more than anything else is that OPEC is really looking to flood the market now, really flood the market. So we're probably going to see a five Not probably. We're going to see a 5 in oil, but there's potential to see a 4. If you look over here, you're looking at oil. It basically lives between 40 and 60 bucks is kind of where it's been living for, a long time, a really long time. Granted, we broke out of it, we're coming back in, we've been hanging out in the 60 to 70 area. I get it, but it really lives over there. The problem is oil below 60 starts to become a real challenge for a lot of companies, which could be which could add to the layoffs. So there's a lot going on. I advise you all to do your reading, understand what's going on. Don't just click away on buttons. You know, there's just a lot. Brexit, if you remember Brexit, for those of you who were around for Brexit, was a challenge. The US has now basically kind of done its own Brexit moment, and it's a self-inflicted gunshot wound. What happens here? I don't know. And most people that I'm talking to also do not know. There's so much heightened uncertainty right now. Nobody really understands what's going on, where things are going. And you could say, oh, just to put a button on this, if you look at the auto sector and what's happening there, just from a credit perspective, if you look at some of these auto financing companies or some of these financing companies like Carvana and Upstart and I forgot what the other one was. They got creamed. They're getting creamed. Now you could say they're not really finance companies; they're more tech companies and tech finance and yada yada yada. Credit spreads are blowing out. So even though yields are going down, access to credit is becoming much much harder. It's going to become so hard because the U.S. is a financial economy or financialized economy. The US needs credit free flowing. And if credit spreads are blowing out because yields are going down for the wrong reasons, this is not a good thing. Okay. That's the bear case. The bull case, the storm passes. We find a way to kind of get out of this without having egg on our face. Hopefully, we're able to repair the damage that we've done to our partners and other countries because of, we're just showing that we're not dealing in good faith. Is it a good thing bringing jobs to America back into the country? Yes. Is it a good thing for companies to repatriate cash here in America? Of course. Yes, it's a good thing. But just how we go about it is going to be a little bit of a challenge. Okay. As always, do yourselves a favor, be prepared. Don't come in relying on somebody else to give you levels or to give you their levels or to give you something. Don't do it. Be prepared. If you don't do your homework the night before, don't be in the market. Any market, whether it's stocks, whether it be currencies, futures, whatever it is. If you have not done your homework, do not be there. This is just, you're going to get hurt and you're going to get really hurt. And it's not just the financial aspect of it. It could be mental and emotional of just getting body slammed. And if you don't know what you're doing, but you think that you know what you're doing, size down. Really, really size down. Because if you don't know what you're doing and you put on size, you're going to get killed. And it's just not worth it. Okay. I wish all of you the best of luck. Have a good week. I may do a midweek um, update depending on what happens. I wish you all the best. Be safe and have a great weekend.